A lesson you can learn from Black Monday is that you need to stick with your strategy when it comes to your investing. Okay, a well-conceived long-term investment strategy based on personal investment objectives should provide the confidence for investors to remain steadfast while everyone else is panicking. What does Warren Buffett say? And I've quoted it before and I will quote it again. He says, be fearful when others are greedy and be greedy when others are fearful. Okay, it's hard to be greedy when others are fearful. It is very, very hard. And it's also hard to be fearful when others are greedy, right? Because when others are greedy, you want to get in on the action. You want to buy what they're buying. You want to get the returns that they're getting or that they seem to be getting, right? Who didn't want to jump into Bitcoin as it was on its meteoric rise, right? And if you just bought it because your friends bought it, right, you were being greedy because others were being greedy, and you weren't being fearful when others were being greedy. And we've seen a large pullback in Bitcoin. Now, it doesn't mean it's going to stay that way, but it shows you that price action can change on a dime. And when price action changes, it is profitable to be fearful when others are greedy and greedy when others are fearful. And like last year, if you would have bought at the bottom of the market, right, you were being greedy when others were fearful, right? You were wanting to put money to work when others were wanting to take money out of the market. And if you would have done so, then you would have made outsized returns on the back end. You just have to stick to your strategy. Be a good long-term investor and do not panic when everyone else is panicking. When everyone else is panicking, it's typically a good time to look objectively at the market and think without too much emotion and see what is good and what is on sale. Okay, investors who lack a strategy tend to let their emotions guide their decision making. Investors who have stayed invested in the S&P 500 since 1987 have earned an annualized return of approximately 10%. Okay, so you see this huge crash in 1987, right? This huge 22% decline, and you think, oh, well, you know, the stock market's going to be down forever. The stock market's never going to come back. It's never going to be like it was. Never, never, never. Never is always the word that you want to listen for, because when someone says that something's never going to happen again, that means it's probably going to happen again. Or if somebody says, this is unprecedented. This is something that you could have never looked for. It's something that we never thought could have happened, right? That means they probably didn't do a whole lot of thinking. Or people really underestimate the ability for things to happen in the market, and they underestimate the impact that certain things can have on the market as a whole. But they also underestimate the fact that when the market is down a lot, that's when some of the best returns can be made on the other side. Yes, if you're invested and the market drops a lot, right, and then it's going to take a lot of time for the market to get back to the place that it was, yeah, that's going to hurt. And yeah, that's going to be a little painful for a little while, because you're going to have to wait for the market to come back up to the place that it once was, right, which may take some time. But if you start investing at a low, or if you invest a lot of money that was just sitting on the sidelines at a low, right, then you should be very optimistic, because you can make outsized returns from the fact that the market is on sale relative to what it was before. Okay, so that's the first thing. Stick with your strategy. Be a long-term investor. Buy and hold and take advantage of opportunities. Then this goes right into our next little lesson here, a point here, is buying opportunities. Knowing that stock market crashes are only temporary, these times should be considered an opportunity to buy stocks or funds. Okay, so what would you do in a scenario like this? I'll give you a quick example of just real world, right? Let's say you'd been looking at some shoes, okay? And you really, really like these shoes, but these shoes cost $100, and you were like, man, I just don't want to spend $100 on a pair of shoes, okay? But, let's say you'd be willing to spend $75 on that same pair of shoes, but $100 is just too much, okay? Then you go back to the same store, a few days later, and they've got that same pair of shoes. No different, same pair of shoes, but they've got that same pair of shoes on sale for half off. So they are $50 today. And you were willing to spend $75 on that particular pair of shoes. You thought that was a fair price for that pair of shoes. Well, now it's at $50. What would you do? Of course, you would buy those shoes. Why? Because those shoes are worth more than what you could buy them for at that particular time. Okay? Well, the same goes for companies that are really good companies, or funds that are really good funds, or just index funds in general, right? That fall a lot in a short period of time, and you thought it may be reasonable to buy them at a certain price, and they fall below that price, right? Then why would you not buy them, right? I think it's absolutely paramount that we take crashes as buying opportunities, because for instance, you look at companies that had no reason to fall last year, but absolutely did at the very beginning of the pandemic, but then came out of the pandemic the biggest winners that we saw, because all stocks were falling when the pandemic was just upon us, right? But if you would have looked at that very time, at that time when everybody else was being fearful and you were greedy, and you looked at the individual stocks that you thought, hey, if everybody was going to be stuck at home, people are still going to be buying goods from Amazon. If everybody's stuck at home, right, then we're going to be doing business over Zoom or whatever it may be. If you would have just looked objectively at that, you could have made so much money from the bottom, because crashes are absolutely buying opportunities. And that's what 1987 teaches us. Then another lesson that we can learn from 1987 is that you need to turn off the noise. Over the long term, market crashes such as Black Monday are a small blip in the performance of a well-structured portfolio. Short-term market events are impossible to predict, and they are soon forgotten. Long-term investors are better served by tuning out the noise of the media and the herd and focusing on your long-term objectives. Because let me tell you this, you can just look at again, I'm using last year as an example a lot, because last year is the most recent event that we've seen that is very similar to a stock market crash like that of 1987. But you look last year, and if you just paid attention during the pandemic as to what was going on, right? I will never forget this as a picture in my mind of watching CNBC, because I like to watch CNBC, right? Talks about stocks, talks about companies, talks about businesses, things like that. That's very interesting to me because I'm a business nerd, I'm a stock market nerd. But nonetheless, right, you watch CNBC, and as the pandemic was going on, as the market was tanking, right, what did you see? You saw that their coverage of the stock market increased, right? They talked more about the markets, right? They had evening shows that they typically do not have about the stock market. And everywhere you looked, something that the three words that I can remember from CNBC were markets in turmoil, right? And they were in big red letters, and it was all over the screen, markets in turmoil. And why is this? Because the media makes money on the fact that people are scared, right? They do make money on the fact that people are fearful, right? People are going to watch if they think that they can get something out of the fact that markets are in turmoil, right? Or they're going to be more intrigued by the fact that bad things have happened than if good things have happened, right? This is just the case with a news media, and nothing against them for advertising it that way or for putting it up on the screen in that way, but that's just the way that they did it, right? But this was noise, right? It was noise to investors, and it was scary to investors when you turn on the TV and it says markets in turmoil, right? Or, I mean, if you just look on any given day, like if the stock market has a bad day, most of the things you see on the screen throughout the course of that day are bright red. They are red. They're getting your attention. It's negative. It evokes emotion within you, right? But you can't listen to the media, right? Yes, I'm not saying you shouldn't watch CNBC, right? You can watch CNBC, that's fine. But don't let everybody's little opinion drive you into making certain decisions. Okay, yes, there are people who have good opinions and they have good, reasonable basis for why they do certain things investing-wise, right? And that's fine if you want to listen to their opinions, right? But you don't have to act on the basis of their opinions. Okay, you cannot be driven by the noise outside of you. You have to make decisions within your own mind, within your own investing process, within your own investing objectives that are going to be best for you over the long term. Okay, you can't allow those outside things to just push you into making dumb decisions. Okay, because what's one of the dumbest things you can do that a lot of people did during the coronavirus crash, and we haven't heard as much about it yet, right? But as time goes on, I'm sure you'll meet a lot of people that said, oh, well, I sold when the market crashed. That's the absolute worst time to sell, right? That is the time when you have to either buy more, which is preferred, or continue to ride the roller coaster, which is perfectly fine as well. But these are people who lacked the education, who lacked the knowledge to make the right decision, that lacked the understanding to know that, hey, this is the worst thing I can do at this given time is to lock in these losses. And they were listening to the noise. We have to turn off the noise that is outside of us. We have to not listen to the herd, not follow what everybody else is doing, not follow people as they jump into Bitcoin at its highs, not follow people as they jump onto Dogecoin because they're looking for quick returns. And I don't even think of that as, that's gambling, right? We're not trying to be gamblers. We're trying to be long-term investors.